in the market is better than timing the market. But what does that mean? I got a question the other day, brother, you know, I'm looking to start investing, but I see the market super volatile. I saw it go down a little bit when, Trump made all the announcements on tariffs. Now it's going back up. Is it overpriced right now? Should I be investing now? Should I have invested a couple weeks ago? Why? When is the exact right time to start investing? And you might have heard, if you've done any type of research on the internet, some finance gurus basically saying that time in the market is better than timing the market. And what they mean by this is that, especially if you have a goal to invest for the long term, right? This is for your retirement or kids' education or for you to grow your wealth or any of these number of things. If you are to try to time the market, it's really hard to pick the exact best time to get in. A lot of people, we've seen the last few days that a trade deal was announced between the United States and China. And because of that, markets have started to go up. But it would have been really hard unless you had inside information, which that's a topic for a whole other video, it would have been really hard for you to know what would happen and, what the cause and effect of that would be, right? But if we look over the course of history throughout the markets, right? Generally speaking, over any 10-year period for an investor, they profit, they make money, right? So what we want to do is we want to be in the markets as long as possible. Time in the market is better than timing the market, right? And some of the reasons behind that is if you miss out on some of the best trading days throughout the last 10 years or whatever, it changes your returns substantially. So let me give you an example. If because the markets go down, you pull your money out because you're scared, right? What can happen is you can have a day like yesterday, which is one of the best trading days over the last few years, right? Because of the news of the trade deal between the United States and China. Now, historically speaking, if you miss out on some of those best trading days, it impacts your overall return over a 10-year period by, 3-4%, which, okay, is that a lot? Not year by year, but as it compounds over the years, it can make a substantial difference. So when we look at the concept of time in the market as opposed to timing the market, what we really want to do is we want to make sure we're spending as much time in the market as possible. We want to make sure we're invested for as long as possible, giving our money as much time as possible to grow. So trying to manage the ins and outs, the ups and downs, all these different things, it doesn't really work out. It makes it a lot harder for you to achieve the returns you want to do. It makes it a lot harder to achieve the goals you want to do. There are some people that can do it successfully. There are some people that trade like this successfully. But for your average investor, what I would say is if you're ready to invest, invest. Forget about the ups and downs in the market and all these other kind of things and put your money in for as long as possible. And the other thing I would say is make sure you're investing regularly. To avoid the major fluctuations in the market, there's something called dollar cost averaging, which allows you to put money in at regular intervals and get the ups and the downs while minimizing the downside risk. So I hope this answers your question. Thank you for watching. We'll see you next time.